Let's bring in CNBC contributor Josh Brown. He's the CEO of Ritholtz Wealth Management for what he thinks. And Josh, is so interesting. When these Bostic comments came out, the market expectations ticked higher. Stocks did not fall off a cliff. Rates did not shoot to the moon. In fact, the 10-year yield is lower. What does that tell you about the market's wherewithal to withstand 100 basis points in 2 weeks?
Well, I think, first of all, the bond market is aware that Bostic is not voting. But you know who is? Esther George. And there is a possibility that if 100 basis points starts being bandied about behind closed doors, more voting Fed members will come around to her point of view, which is not to stop the rate hikes, but maybe to be a little bit more thoughtful about the pace. So this is what Esther has to say. Quote, "The pace at which this path unfolds will need to be carefully balanced against the state of the economy and financial markets." And, basically she's saying it's already a historically swift pace of rate increases that households and businesses have to adapt to. This is what we're living through right now, this adaptation, and no one is immune. Everyone's got to do it. And the question becomes, if you're looking to get to a certain terminal rate anyway, is 2% even realistic to be talking about as the target? You might start to hear that change very subtly. But B, what is the rush if you're already seeing some of the effects that you wanted to bring about taking place in specific corners of the market? So the Fed is getting its way in the housing market. It's slow, but it's undeniable. The Fed is getting its way in autos and auto loans. Repossessions are now exploding. The Fed is definitely getting its way, although probably not influencing it much in terms of energy prices. So there are areas where you could say we're seeing that fall off. The stickiest thing, though, is going to be the wage price spiral and fighting that. And that's going to, I don't think that takes faster rate increases. I just think it takes more time. But think about it. The cost of goods sold in America, 50 to 55% of that is labor. And rents are not budging to the downside. In fact, they continue to go higher. Now, the Fed doesn't look at CPI as much as they look at PCE. And the difference between these two metrics is that PCE has less of a concentration in rent, in real estate. CPI is more. So it's possible that PCE is a little bit more moderate than what we saw this morning, and maybe the Fed continues to pay closer attention to that. So look, it's complicated.
I get it, but you are well aware. You are well aware the current state of the economy because you've talked about it on halftime and on overtime on numerous occasions. I referenced with Richard Fisher the conversation I had a few hours ago with the Wharton professor Jeremy Siegel, who is now making his case that the Fed is not going to be as aggressive as they once were because of the state of the economy. He also talks about what he thinks will happen in the stock market, because that's ultimately the point that I want to get to. Let's listen to the professor. We'll kick it on the other side.
The market will bottom and rally. Maybe in the July, he does 75 and says, listen, we think we've made a lot of forward progress. The prints will still show high inflation, but we feel we've done most of the tightening. Wow. I want to be long on that day. It may not be July, but I want to be long on that day.
So if you believe, as Jim Cramer suggested earlier today, Josh, that this could be the last really hot inflation report, as Tom Lee has made the case, and as the professor, I think, believes as well, why wouldn't you want to be more optimistic today about stocks if you think, in fact, that will be the case?
Well, I actually agree with what they're saying, but there's a caveat. The caveat is be careful what you wish for, because if the reason we can get past this and say that was the hottest print is that we have pushed the economy into recession, it's certainly not the end of the world, but it's not the bottom for the stock market either. So, look, you will have a massive rally if you get any kind of signal from the Fed that they think they've gone big enough with the last few hikes, and now they're going to observe their handiwork. You will absolutely get a big one-day, maybe even two-day rally. But we are very far below the declining 200-day moving average. You look at a stock like Microsoft, Judge, This is the furthest Microsoft has been below its own 200-day moving average since the great financial crisis. We're talking about a 12-year low in that stock, maybe the second most important stock in the world relative to trend. So even if you get that 1 or 2 day snapback rally, what happens after that is everyone says, all right, that was fun, but wait a minute. Recession is real and maybe even quicker than, happening quicker than today. The 10s and 2s invert, the worst inversion we've seen yet. 20 basis point inversion before things fell back down. So that's really the bigger risk. And look, I'm not telling people don't play for that big rally when the Fed says it's going to relax. I'm just saying, don't get too excited about it either.